there is a danger that we could have a nasty recession. We may see more inflation for longer. The possibility is it'll start destabilizing banks.
Recently, I think it was just last week, we had a blowout on the jobs data in the US. How do you see this affecting their potential rate hikes in the kind of near future, in the near term, 2024, and how do you see that affecting the kind of Fed funds rate?
Well, I think, to me, all of this plays back into the narrative of volatility. Yeah. And you get these month-on-month blowouts. In the 80s, when I first went into financial markets, analysts used to run out of the Bank of England. They used to put tuppence in a telephone call box. They used to call their offices and used to say interest rates had just gone up. So the speed of information has increased, the volume of information and data has increased as well. So you get these month-on-month figures. I mean, people did look at jobs data in the 1970s, but in a sort of slightly different way. It was all about the rate of unemployment. But they certainly didn't look at this sort of, the volatility from month to month and then try and guess. So to me, that plays into the narrative of volatility. Yeah. And you'll get it blowing out on one way, and of course then the Fed will get nervous and they won't bring down rates, and they may even put up rates, and then you'll probably get a blowout in the other direction. It's some months down the road, you're going to get a figure for employment rates, jobs data, where everyone's going to say, oh my gosh, that was much lower than we were expecting. It's all a disaster for the economy, and and everything goes in the opposite direction. Yeah. So I think it's part of the narrative of volatility.
Great stuff. And then how does the bond market play into this? Obviously, we've seen 5% yields on the US Treasuries. How do you think it's peaked, first of all? And how does the bond market play into the price of gold?
When I talk about real interest rates, what I'm doing is the Fed funds rate relative to CPI inflation. The bond rate is another measure of interest rates. And at the short end, it's not usually very far away from the Fed funds rate, so you should see the same sort of thing. But essentially, it's tracking, first of all, what the Fed does, and then it's tracking what it thinks the Fed is going to do. So from that perspective, it's quite an interesting thing. And, it has peaked. But if you look at the longer end, actually, yields haven't gone up as much as I thought they might do, or perhaps by as much as would have been suggested. And so there's a bit of a disconnect, I think, in what's happening in the bond market at the moment between the short end and between the long end. And certainly one of the conclusions you can draw from that is people are still looking at inflation as a slightly transient thing. Yeah. And it may be that inflation is less transient than at the moment the financial markets have baked in, and we may see more inflation for longer. And I think that's a positive. Again, it depends on how the Federal Reserve reacts to that. But it looks like the market thinks that we got this bump of inflation. It's going to last maybe another couple of years, that sort of thing. Yeah. But then presumably we're going to go back to some sort of normality, and I think the potential does exist for that hump in inflation to go that little bit further out. Maybe it's not 2 years or 3 or 4. And I think we'll see a little bit of that going forward as well, is that whilst we think we got inflation licked, actually it's going to rear its head again, from time to time in an unpleasant and probably unhelpful and a way that is very bad timing, almost certainly, for the economy generally speaking. And that's one of the things we're going to have to, we, governments, the US, the Federal Reserve, again, A, have to live with, and B, have to manage.
Yeah, I mean, I've seen quite a lot more recently of, I've seen articles, analysts coming out and saying, we thought the hard landing was behind us. They thought that, the US had achieved a soft landing. Global recessions were kind of the thought that there would be a global recession was kind of tapering off. Has that changed for you at all in the last kind of couple of months? How do you see the general global economic outlook? Do you think we're kind of past the worst of it?
I really hope we are. Yeah. I think we probably have to accept that there is a risk that we're not, and if inflation proves to be more ingrained into the system than we thought, we might have to have interest rates higher for longer. There is a danger that we could have a nasty recession. I hope we don't. And I'm looking to the Federal Reserve, and I suppose in this country to the Bank of England to manage that. And one of the big things is keeping interest rates at a level that isn't going to crush the real economy, isn't going to destabilize the housing market, because if it does, then the possibility is it'll start destabilizing banks, and then we're suddenly in a very unpleasant place. You know, we're in the sort of place that we were in 2007. I hope that the worst is behind us, or nearly behind us, or this is the worst. But, you know, as they say, well, you should hope for the best and prepare for the worst. Yeah. And so I'm hoping for the best, and I hope they're preparing for the worst.
Yeah. And you brought me quite nicely onto my last question, which was about banks. We've got earnings season coming up. We've had a kind of quite a long period of high interest rates, and bond yields are quite high. How do you see the stability of the banks, particularly in the US? We've just had Metro Bank having problems here in the UK. How do you see this stability for the banks at the moment? How do you expect the kind of earnings seasons to go?
I know. I probably should say I'm not a banking analyst here. You know, what I hope we're getting back to is the old scenario of the sort of, you know, the 3-5-3 situation where they borrow at 3%, they lend at 5%, you're on the golf course at 3%. And that's, you know, that it would be a nice sort of situation to get back to that sort of scenario. Metro Bank, I think, does give an example of the sort of things I was talking about, you know, how banks can get into trouble. And when banks get into trouble, you can see this contagion. You know, I think the stability of banks, if you look at their sort of tier 1 capital ratios, they're better than they were in 2007. So that gives them, if you like, a larger cushion if things start getting uncomfortable. But, you know, however thick your cushion can be, you can probably bore through it if the scenario is wrong. So, yeah, I think the banks are in a reasonable place at the moment, but that doesn't mean to say we should be complacent.
And that brings us nicely to the end there. So thank you very much for joining us today.
Thanks, Tom.
And don't forget to like, comment and subscribe at home, and join us next time.